Silver miners have historically been one of the most volatile corners of the commodity equity space, and for investors looking to capitalize on silver's industrial and monetary demand, there's one ETF that dominates the category. Today, we're breaking down SIL, the Global X Silver Miners ETF. Welcome back to the ETF Investor. On this channel, we cut through the marketing to help you understand exactly what you're buying when you invest in an ETF. SIL is one of those funds that looks straightforward on the surface. Silver miners, simple enough. But the way it's constructed and the risks involved deserve a closer look. Let's get into it. SIL tracks the Solactive Global Silver Miners Total Return Index. The fund aims to capture the equity performance of companies involved in the silver mining industry globally. That includes pure-play silver miners, but also companies engaged in exploration, development, and refining activities. Now, here's something important to understand right away. You're not buying silver when you buy a SIL. You're buying the companies that mine it. That's a critical distinction because mining companies carry operational risks, management decisions, cost structures, and balance sheet considerations that physical silver doesn't have. Let's talk about how this index is built, because the methodology matters. First, the universe. Companies must derive a significant portion of their revenue from silver mining or related activities. From there, the index applies a liquidity screen. Stocks are ranked by their average daily trading volume over the prior 3 months, measured in US dollars. The portfolio typically holds between 20 and 40 stocks, so it's relatively concentrated compared to broad market ETFs. It's market cap weighted, meaning larger companies get bigger allocations, but there are caps in place to prevent any single holding from dominating the fund. The index rebalances semi-annually, which keeps turnover relatively low while ensuring the portfolio stays aligned with the methodology. When you look at SIL's holdings, you'll notice some names that might surprise you. Many of the largest silver miners are actually primarily gold miners that produce silver as a byproduct. You'll typically see companies like Wheaton Precious Metals, Pan American Silver, First Majestic Silver, and Hecla Mining near the top of the portfolio. Wheaton is actually a streaming company, not a traditional miner. They provide upfront capital to miners in exchange for the right to purchase metals at predetermined prices. It's a different business model with different risk characteristics. The geographic exposure skews heavily toward North American listings, though the underlying mining operations span Mexico, Peru, Canada, and other silver-producing regions. Here's where we need to have an honest conversation about what you're signing up for. Silver miners are leveraged plays on silver prices. When silver moves up, miners typically move up more. When silver drops, miners typically drop harder. This leverage comes from the operational nature of mining. Fixed costs mean that changes in the silver price flow disproportionately to the bottom line. Historically, SIL has exhibited significantly higher volatility than both the broad equity market and physical silver itself. We're talking about a fund that can easily move 40, 50, even 60% in a calendar year, in either direction. This isn't a criticism of the fund. It's doing exactly what it's designed to do. But you need to go in with realistic expectations. SIL carries an expense ratio of 0.65%. For a niche, thematic ETF focused on a specific commodity sector, that's in line with what you'd expect. You're paying for specialized index construction and exposure to a concentrated industry. The fund has been around since 2010, so it has a substantial track record. Assets under management fluctuate with silver sentiment, but it's generally the most liquid option in the silver miners ETF space. One structural note, because many silver miners pay dividends, particularly the streaming companies, SIL does generate some income, though the yield varies considerably year to year. SIL makes sense for investors who want equity exposure to the silver mining industry, believe silver prices are heading higher, and can stomach significant volatility along the way. It's also used tactically by investors who want leveraged exposure to silver price movements without using actual leveraged products. This is not a core portfolio holding for most investors. It's a satellite position, a tactical allocation, or a thematic bet on precious metals. If you're looking for stability and steady compounding, this isn't it. Beyond silver price risk, you're taking on company-specific risks across the portfolio, operational issues, regulatory changes in mining jurisdictions, labor disputes, environmental considerations, and management execution. Currency risk is also a factor since many miners operate internationally but report in various currencies. And concentration risk is real. With only 20 to 40 holdings in a single industry, one or two bad actors can meaningfully impact returns. SIL is a well-constructed ETF that does exactly what it says. Gives you exposure to the global silver mining industry through a market cap-weighted, liquidity-screened portfolio of miners and related companies. Just make sure you understand what that actually means. Volatile, concentrated, and leveraged to silver prices. If that fits your investment thesis and risk tolerance, SIL is the standard choice in this space. If you found this breakdown helpful, consider subscribing for more ETF analysis. I'll see you in the next one. Drop a comment below. Are you bullish on silver miners or do you prefer physical silver exposure? Let's discuss.